Hi, Eric here from 5minuteinvesting.com. And today we're going to talk about the two types of investors that I commonly see in the stock market. And it is very important to know which type you are. And once you know which type of investor you are, then you know how to invest. So what are these two types of investors? Well, the first investor buys every single dip in an uptrend. So the first type of investor buys in the dip of an uptrend. So every time the price retraces or come back down, you buy it. That's the first type. And as the first type of investor, you usually don't trade against the market because you know that the trend is generally up. The second type of investor, I call it the turnaround investor. So when you buy a company, let's say it's performing poorly, you expect somehow that it will turn around, maybe because of a restructuring, maybe because the internal process is going to change, maybe because the oil price after it dropped is going to go back up, so then you decide that the company will turn around as well. So why are these two types of investors important? Because when you look at the chart, you are going to see ups and downs. And if you are a long-term investor and you buy every single dip, 9 out of 10 times you're going to be right because the trend is in your favor. Time is in your favor. So 9 out of 10 times, the price will continue to go up because the trend is up. And of course, if you're buying a stock where the trend is not up, then you can't do this. The second type of company, you're functioning more like a restructuring investor or a turnaround investor, whether you hope something fundamentally in the company will change, so then you buy it. Whether that is a restructuring plan, or it gets acquired, or some new partnership, or whatever. You get the idea. So the fundamental trend itself changes, and you make a huge profit. Now, the problem with this one is you don't know when the market will go against you, right? Because you don't know when the market will come back down. It's hard to predict a crash. In fact, I don't think anyone can. But 9 out of 10 times, if you count the number of dips you get before a crash, usually it's 9 to 1. So every dip you invest, 90% of the time, you are going to have this little trend afterwards that will lead to profitability. So 9 out of 10 times, you're going to make money. And here, you're going to get the same trend except in the opposite direction because you're trying to guess where the bottom is. And you're going to be trying to buy at every single dip below. And hopefully, the dip you're buying is the last dip and it turns around and shoot up. So when you're buying a company that you aim to that it will turn around, 9 out of 10 times the dip you're buying is not the last one because you're hoping for a fundamental change in the trend. And that is really rare. So you better know what you're doing if you're choosing to be this kind of investor. So when I teach people, I always teach people to be the first kind because it's a lot easier. And when you're in a general bull market, it works really well. So the only thing you need to pay attention for is a fundamental change from an uptrend to a downtrend. And that's it. That's the difference between the two investors.